But you can continue analyzing the charts as other will keep joining.
It's okay. So currently, I had already analyzed this trade. I analyzed it in the morning. So when you check on the weekly time frame, gold has been bullish for a long time. So we can see how each week was closing, at least the lower week was closing above the previous low's week. The same applies to what happened the previous week and what is happening this week. We are expecting to push higher. So we shall be targeting 5,600 and some other targets below here, 5,400. So when you go on the daily time frame, how the price has been reacting recently, we can see the last week, the candlestick for Thursday, how it closed, the candlestick for Friday, how it closed, then at the candlestick of Monday, how it closed. So the candlestick of Monday, it closed above the lower week of last week is Wednesday, Thursday, and Friday candlesticks. So it was showing us that buyers have taken over the market. So when you go on the 4-hour time frame, let's go direct on the 1-hour time frame. So in the 1-hour time frame, we spotted this is a break of structure, which was showing us that buyers are already taking control of the market. So price was leaving for us. There's this demand zone. Price didn't go up to this area. Then there's also this demand zone right here. So price gave us some reaction on this first demand zone. So this one we neglect it. So this one is the one which we considered. So when you go on the 15-minute, we got a change of character, which is like change in state in delivery, showing us that price has shifted from the downtrend to the uptrend, which is this small one which we got here as our change of character or market structure shift, MSS, leaving for us a small demand zone here, which is also having some liquidity here. Also, this demand zone which we marked here, it was also having this liquidity here, which was our inducement. So here price gave us a break of structure, showing us that now buyers are in total control of the market. So this second entry was at a 30-minute fair value gap. This gap which is between these three candlesticks. That is where we got our second entry, which is this one, which is running right now. So in order for us to get a second entry, price has to break this high. After breaking this high, we shall be targeting the other liquidity, which is at 5,239. But then, after breaking this high, we shall be expecting another demand zone. Shall be expecting another demand zone here, where we shall be expecting to push higher. But then if price pushes higher continuously, we shall be expecting still price to come back to our discount zone. Discount zone is below 0.5. That is the discount zone. Let me check whether this guy has joined.
Yeah, I've joined.
Are you
Don't know
already
if
there?
yeah, I don't know if you can hear me properly.
Yeah, I can hear you very well. All
Yeah,
right.
so I think I'll analyze the JPY basket and the DXY meanwhile, because basically they are the two indices we are going to check on for us to know what we are going to trade in these coming weeks.
Yeah.
So let me first load my charts. So I'm going to share my screen in a few.
Yeah.
Alban, continue.
Meanwhile,
Continue
yeah,
when he's
Alban,
ready.
continue
Yeah.
meanwhile.
Yeah, he's still loading his charts.
Oh, you can continue explaining with your chart. When he comes, then it just switches.
It's okay.
Alban, continue.
Meanwhile, yeah, Alban, continue meanwhile.
Oh no, there is some trade which I had also on it was on Ethereum. It was there's this trade which I got on Ethereum that is on Monday. So the way Ethereum moves in the same direction with Bitcoin. So it is matter of mastering how the candlestick
You
closes.
share your screen, share the charts. Don't leave it to be like this screen is not supposed to be like blank like this.
Oh,
Remember, if you're streaming to people, most of the time it's not talking. You have to talk when the chat is there.
I had removed the
Mm. And remember, you're doing a 2 hours live stream, so one person can go 1 hour, another person can go for the next hour.
it's okay.
So you can
So
still
this is
proceed in the
this is
direction.
the trade which I'm talking of, Ethereum, which I got on a Monday. So Ethereum, according to the way it was moving, it is choppy. It is it is not in an uptrend, it is not in a downtrend, it is just in like a consolidation. But when you master how the candlestick closes, like what happened here, how the candlestick closed, meaning that buyers have taken control of the market just that single day. Because a candlestick, if the candlestick wick closes within the previous day candlestick wick, that means that buyers have taken control of the market that day. So you shall be expecting to push in the other opposite direction, targeting the high of the other previous day. So usually I take 3 candlesticks. Show me this is candlestick 1, having candlestick wick, candlestick 2. So if this candlestick 2, because when it is opening, is coming downwards. So we are in a scenario of a bearish market. So then when it forms coming downwards like this, it will form with the candlestick wick. So as it is closing, it will close when buyers are pushing it higher. So when it closes like this, we shall be expecting price to continue higher the following day, targeting this other previous day high, targeting this other previous day high. So that's the same thing that happened here. That's the same thing that happened here. So that is also the same thing that has been happening here. So meaning if a candlestick closes if a candlestick closes above let's assume this is candlestick 1, which is day 1, day 2, day 3. So if the candlestick of day 3 closes above the candlestick of day 1, meaning we are going to push higher. So we shall be expecting price to come and retrace, then it pushes higher. So in this candlestick of day 3, we usually mark using the Fibonacci tool. We mark from the daily low up to daily high. So when we mark the daily low and the daily high, our 50% is here, which is 0.5. So this is 0.5. So this is 0.5. We zoom in to the lower time frames and we see below 0.5, which is the 50%, what is there? We might be having a fair value gap, we might be having a demand zone, or we might be having liquidity levels like session lows, which is usually the Asian low or the London low. Then we target the other one. We usually target, you might target this level. You might target this level again because price cannot resume from here, it pushes immediately. It has to first retrace. There are some liquidity levels, fair value gaps, where price has to come and first balance the price. Or the other day, which is maybe here, before the day 1, which we had marked, it can also be our target. It can also be our target. We can also target this level right here. So that is the candle range theory. Marking the candle range theory, then you understand how the candlestick forms. If a candlestick forms in this way, what does it mean? A buyer is in control of the market, a seller is in control of the market, or no one is in control of the market. Market is just consolidating. So that's the same thing that happened here on this trade, which I got on a Monday. So this was a prior day low. This was a low of prior day low. This is a low of a certain day, which is a Monday. This one is the low of Monday. So this low of Monday, price closed above, and it gave us a bullish. It gave us a bullish candlestick that closed above the last bearish candlestick. So we mark that body, the upper body of the candlestick. We usually call it change in state delivery. So when you go like on the 30-minute time frame, when you go on the 30-minute time frame, you can see this one is a clear liquidity sweep. So liquidity levels, we usually have daily low, a daily high, session lows, session highs, weekly lows, weekly highs, monthly lows, and monthly highs. Those are our liquidity levels. What we take as liquidity levels, resting on those levels. So when price usually taps on those levels, and once it crosses above or below, then we are pretty sure that now the market has finished that phase of seeking liquidity. So now we are going to expand higher. That's what happened here. Price grabbed this prior day low. It shifted higher, creating this change in state delivery, leaving a fair value gap. There's a fair value gap here, a gap between these 3 candlesticks. This candlestick, this candlestick, this candlestick. So that is where we got our entry, targeting day one high, which is this one. Though price did not hit the TP, but we got another entry here. This entry, I got it yesterday. The same thing happened. This is a prior day low. This is a low of some day. This is a Yeah, this is the Tuesday low. So this Tuesday low, price grabbed its low and it closed above. So when it closed above, we go the same thing. We go the same thing. When we zoom in, you can see there is a fair value gap here. And what is interesting at the same time, this is an Asian range. This is an Asian range. So this Asian range, price grabbed its low. Price had already grabbed its low. So this is also another second confluence. Price grabbed the low. At the same time, it grabbed the previous day low, and it price closed above, leaving us an imbalance where price came and filled after. That's also a good entry. Targeting the other day. So they are supposed to be two running trades. But when you look close, what happened today? Price had expanded this below, so meaning our trade is still running, though price had retraced back to the entry point, but also the price was running very well. There's also some other trade. Some other trade. There's a trade which I'm waiting for here. I've been waiting for this trade since morning, but I haven't got a clear confluence to enter this trade. But let's first analyze from where this week started from. So last week, as it was closing, our price had given us a clear fair value gap here. This gap which is here. And when the last week was ending, price had to struggle high so that it can at least close above this fair value gap here. So when Monday was opening, it opened from here. So this is Friday candlestick. So we're having the same thing, change in state delivery on the daily time frame. Now this change in state delivery, it was marked on the Tuesday candlestick last week. So this, when you go on the 1 hour time frame, this is our change in state delivery, which was on the, let's use the 4 hour time frame. It is this one which I marked on the daily time frame. This change in state delivery on the 4 hour time frame, it is here. So when Monday was opening, price had to retrace back to this level. But when it traces back, you don't just enter into the market. You have to first get a clear confluence that gives you a clean entry. So when you go on the 1 hour time frame, this is our change in state delivery. You can see the same thing, another change in state delivery. When the price pushed higher, this sell candle that was formed here, then this buy candle that pushed higher, it left for us a change in state delivery. Then when you look close, there's this fair value gap here. There's this fair value gap here. That is an entry on this trade of GBP GPY. It was a very, very clean entry here, putting our stop loss slightly below here, risking around 30 pips. Then we can either target this high, or we can hold the trade, because I shared this setup with some guys. I think most of them exited, but those who are still holding, there was also some other exit point here. It was kind of like a swing trade. So when you look close, when you look close, there's this sell candle which is here. There's this sell candle which is here. And when the price closed above, this was also another entry. Change in state delivery. It was also another good entry. The same thing happened here. So where I don't usually see the same pattern. Now, like here, what happened? I didn't see the same pattern according to how I trade. It was having some bit of noise, so I didn't expect to get an entry there. But then here I go the same thing. This one was a daily low. This one was a prayer day low, and this one was the last sell candle in this range. In this range was the last sell candle. So this last sell candle will mark its body, its high body. And when the candle closed above, this candlestick closed above, that is also another entry. That is also a change in the state delivery. That is a XAUUSD. So that was also another entry, risking around 20 pips. Of course, targeting, we look close. What is this side? Are there some liquidity levels? If there are some liquidity levels, those should be our targets. Now there is like this liquidity level which is here. This point is a very good target. This point here. So we target like that point. We target like that point, and it was a very clean move, which is zero drawdown. Now the same thing I'm waiting for here, but today price is having a little bit of a ranging. So, but if price closes above this point, then I'll be having my buy position. Because when you look at the daily time frame, how Wednesday candlestick closed, it didn't close within this candlestick of Monday. So it is giving us a signal that we are supposed to be pushing higher. So whatever price is doing right now, it is generating liquidity. So either today or tomorrow, this liquidity has to be swept. Because each range that happens in the market, it is price trying to generate liquidity. And once price generates liquidity, it has, of course, to grab that liquidity before making any other move. There's also USD/GPY. USD/GPY has also been giving us some good moves. Very, 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 very nice moves. Very, very nice moves. When you check here, according to the way the price closed, there was a fair value gap. I'm going to be explaining what a fair value gap is. There's a fair value gap here. Here, candlestick. The Friday candle closed within the Thursday candle. That is also a signal that we are going to push higher. The same thing happened here. Price. Now look at this example here. Look at this example here. Last week is Tuesday candlestick. It closed within. It closed within the Monday candlestick. But then Wednesday candlestick pushed lower in this fair value gap here. In this fair value gap here. So market is usually having very many scenarios. So like the other scenario which I was showing of a candlestick forming within, it might happen. Now like here it happened, but price did not push up to this point because we are currently in a bullish market. This one happens when it has closed where there was a fair value gap, Like what happened here, it is in a fair value gap. Now the same thing happened here. The same thing happened here. Price closed above, leaving in this week. This one was a good signal, meaning this one happened on last week, Thursday. So meaning whatever happened on Friday and this week, it was totally bullish. Now let's see some of the setups we will get from this point. Some of the setups we will get from these points. This was our prior day low, PDL, prior day low. So you can see that price closed. We usually have these candlesticks, the last sale candlesticks that when market sellers were involved in the market. And there's also a fair value gap. When you go on the 30-minute, I think on the 30-minute is visible. Yeah, on the 30-minute, the fair value gap is kind of visible. So we are having this previous day high here. This one at this point. So this one was actually a very nice buy. It was a very nice buy, putting the stop loss slightly below, like risking around 25 pips, targeting that is 86 pips. So we can see the same thing happened here. This is a prior day low. This one is a prior day low. Prior day low. So when you go on the 1 hour time frame, this is our PDL, prior day low. So as usual, our candlestick, our last sale candlestick that when the sellers appeared in the market before the price reversed, this one was also a nice entry, targeting this level right here, because this is the last liquidity that price had left in the market. So this was also another very nice entry here. After price immediately closed above, you just take your entry, you put your stop loss slightly below, targeting the other liquidity there. So there is this is, let me go back to the daily time frame. So what was happening? So this is also the Friday low. So on Friday there was NFP. So NFP, it usually leaves, there is NFP high and NFP low. So that is Friday high and Friday low. So when a Monday opens, we usually target Friday high or a Friday low. So that's why usually on Mondays, we don't usually trade, because on Mondays, the market is usually having a lot of manipulation. So now on Wednesday, sorry, on Tuesday, price came and it grabbed for the Friday low, which is here, which is this one, which we are seeing here. It grabbed the Friday low. So this is our prior day low, PDL, which is the Friday low. So when you go on the 1 hour time frame, our PDL is this one. You can see our usual candlestick, which is this one. This zero candlestick, which is here. As long as price has closed above this last sale candlestick on 1 hour, that is when you take that is when you take your buy position. So our buy position was to be here, immediately above this candlestick closure. We put the stop loss at least, because this is our protected draw. So if it is our protected draw, according to our risk, maybe I'm risking like 40 pips, because USD GPY, its people volume is different from other pairs. Because when you check like on gold, this stop loss you find is like 300 pips. But now this one is showing 37 pips. If you check on Bitcoin, you find is like 60 pips. So people volume is different. So of course, targeting this liquidity here. So we usually target the previous day's highs. Those are our liquidity levels. Because the lows have been grabbed, now we are targeting the liquidity levels on the other side. That is the sell side liquidity. We have swept the sell side liquidity. We are targeting the buy side liquidity. Now this was the entry which I was saying. Now we go to this entry which I entered yesterday. Same thing. This is the PDL Pradero. This one. PDL Pradero. The same thing happened. The last sell candlestick, we mark its body high. The moment the buyers close above that candlestick, we take our entry. Now the stop loss is supposed to be at least, or when you're almost below this protected draw. And the target should be the liquidity, the next liquidity. The next liquidity are the previous day's high or previous week's highs. These levels which are here. These levels up here are the ones which we are supposed to be targeting as our liquidity levels. So we can easily see that this is the real uptrend which they talk about. When you're reading maybe like a book or a PDF, you usually see higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, just like that. That is the way an uptrend is. But then the thing is, how do we know that this is the lower low and we are supposed to be buying? That's when we zoom into the daily time frame, we mark and see, has the previous day low, today's low, today's candlestick week, has it closed? Has it given us a confirmation after closing above previous day low? Yes. Let's get our change in state delivery. We'll get our entry. So this trade is still in. So when we check on the daily time frame, so whatever happens tomorrow, we are expecting two things. Because now there's this candlestick week, and there's also this candlestick week of Tuesday. Candlestick week of Tuesday. So it will have formed what we call a fair value gap. So a fair value gap is that space which is between three candlesticks. Let's assume this is candlestick 1. This is candlestick 2. We are giving a scenario in a bullish market. Then this is candlestick 3. Candlestick 3. Let me give them wicks. This is my drawings have disappeared. Let me draw again. Let me use big ones. That is candlestick 1, candlestick 2, then candlestick 3. So this is the candlestick wick. This is the candlestick wick. Another candlestick wick of candle 2. Another candlestick of candle 3. So there are 2 ways we get biases. Because we are day traders, some of us, we usually hold the trades maybe you hold the trade like from 10 a.m. up to maybe in the evening. You hold the trade both in the London session and maybe New York session, or you hold the trade for like 2 days because your target has not been hit. Because when you know what you're doing, you know that I'm targeting this liquidity level. Because when you understand the 3 concepts in the Forex market, that price generates liquidity, it seeks for liquidity, and it balances the price. So when you talk about balancing the price, that's where the fair value gap coming from. So we mark the high of candle 1, the high wick of, then we mark the wick of candle 3, the lowest wick. So this is space which is in between. This is space which is in. It is the one we refer to as a fair value gap. A fair value gap. My internet has. It is the one referred to as a fair value gap. So as the price is doing the 3 concepts of seeking for liquidity, generating liquidity, and seeking liquidity. So the seeking of liquidity, that is when price comes back to this level. When it comes back to filling this imbalance, it will have grabbed this low, previous day low. So this the next day it might fall. It comes to this level. It comes to this level. It comes to this level. Then it crosses above. So when it crosses above, then we are having 2 serious confluences. Price has filled this imbalance, so meaning the price is balanced. So if it is balanced, then there is no any other need of price coming back to this lowest points, because there is nothing there. It is just targeting these other levels, because as price was coming like this, then price is targeting these other levels. These other levels as the internal range liquidity levels. So now after price has crossed above the previous day low, we shall be looking for our buys. So we shall not wait for the day to close, but we shall go just on the 1 hour time frame. We shall go on the 1 hour time frame. We look for our change in state delivery. That is the hour CISD. We shall look for the last bearish candle. We mark its high body. So after marking its high body, we shall wait for price to cross above. Then we take our buy position. So we shall take our buy position, targeting, maybe you're targeting the open of this day, or you're just targeting this level, or you're targeting the liquidity levels which are this side, So that is fair value gap. Fair value gap at the same time, prior day low liquidity sweep. So what we have seen on GBP GPY, what we have seen on GBP, GPY, price is generating liquidity. What you have seen here, price is generating liquidity. Now let's put, we are having some indicators which we use, especially when you want to know, because the Asian range is usually having the manipulation phase. So it is usually having the accumulation phase. So in that accumulation phase, it is liquidity level. Liquidity levels. Because when they ask that, what are some of the liquidity levels? Well, how should I know that this is the liquidity the price is aiming at? How will I know? First of all, the New York high and low, the London high and low, the Asian high and low, those are the liquidity levels. So this indicator is called, when you go on the indicators, it is called Sessions by Rax Algo. So even if you leave it at default, then you come maybe you disable New York, you disable London session, and you only leave it. It is total. You just leave it the way it is. So when you leave it the way it is here. So there is also a confluence. This move here happened in the Asian session. It happened in the Asian session. The same thing here. The same thing here. Most of the moves of GBP, GPY happen in the Asian session because GPY moves very well in the Asian session. So, but if you get an entry, no matter the session, you have to take your entry as long as it is within your trading criteria. So we can see this is our Asian row. This is our Asian row. So price came, it grabbed the Asian row. It grabbed the Asian row. So what we are waiting for, we are waiting for the same thing, change in state delivery. So this candlestick is for buyers, it is going to form. After it forming, whatever else that will form, we have to wait for something that we know. Price might push higher, leaving a fair value gap, then we get our entry. Or as it pushes higher, it might leave for us a change in state delivery. A sell candlestick, we mark its body, then we get an entry. So that is the trade which I'm waiting for on GBP GPY. So if someone who entered anywhere here has been in, you're going profit, loss, drawdown, what, because you literally don't know what price is doing. If it is in the phase of manipulation, you have to wait for it. If in the phase of accumulation, you have to wait for it. Then you have to get involved in the phase of distribution. After price has finished doing all the three principles, it has generated the liquidity has been grabbed, so we are going to be distributing. That's when we shall be getting involved. If price generates liquidity, it has to grab that liquidity. Then it expands higher. That is the distribution phase. Then previously there's some trades which I captured. This is Bitcoin. So far I have Bitcoin. Same thing, same concept. Candlestick closure. How was the candlestick closed? How was the candlestick closed? The same thing happened here. This is a session row. So if a session, it usually gives an open and closing. So when the session opens, it is having session high and a session low. So if the session high is swept, that is a liquidity grab. If the session low is swept, that is liquidity grab. Then what should we look for? Should we look for buys, sells? If we want to look for buys, how has the candlestick closed for the previous day? Has it closed within or it closed below? If it closed within, then we are looking for buying opportunities. And that is the same thing that happened here. So on the 1 hour, it was actually very, 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 very clean. It was actually very, very clean. So this one was changing state delivery. When you go on the 4 hour, it is actually it is very clear. But then when you go on the 1 hour, there's actually the other change in state delivery. There's also a fair value gap here. There's this fair value gap here. And that was a massive entry. So Bitcoin, gold, they are usually having massive entries. So this was the trade on Bitcoin. This is the change in state delivery. This is prior day high. Then this is the Asian low range sweep. We usually call it a turtle soup. That is a term in ICT. So if I'm to give out all the entries, sometimes now when you go like on the monthly time frame and we look at GBP USD, when you go on the monthly time frame and look at maybe GBP USD, there is a fair value gap that is between this week 1, week 2, week 3. There's this fair value gap that was formed here. This one is on the weekly time frame. But then when you go on the daily time frame, we shall anticipate according to the candle closures, like the way the candlestick closed here. This one was signaling that sellers have taken over the market. So we shall anticipate according to the candlestick closure. But then you have to make sure that our targets are not beyond this fair value gap. As the week goes, we shall be seeing how the price is reacting so that we can know what we shall be doing in the other weeks. So when you look at the candlestick of yesterday on Wednesday, it closed below Monday candlestick. You can see when you zoom in, the candlestick closed below. It closed below. The candlestick body closed below. So when it closed below, we should be looking for more sales. That is the Monday candlestick, sorry, today's candlestick, which is Thursday. So when you go on the 1 hour time frame, so when you go on the 1 hour time frame, so the other first liquidity sweep, is this one, where price swept Monday candlestick. So let's check on the 4 hour how it is. It is this one. It is this one, the prior day high. So when you look at what happened here, price was generating liquidity. So we could not get any entry. But then when the candlestick of yesterday closed, below and it closed below Tuesday's candlestick. It was giving us signal that we are going to push higher. Sorry, we are going to be selling more. But then if we sell more, our target should be on these weeks. It should be Friday week, maybe Monday week. So when you go on the 1 hour, when you go on the 1 hour time frame, this one we shall not count it because it happened in the other accumulation phase. That is on the Tuesday candlestick. So we shall not count that one. So this is the other row where price crossed below. So if it crossed below, what should we look for? Those when the market opened, it opened when sellers are in total control. But then what happened later? What happened later? It gave us a push. It gave us this push here. It gave us this push. So when it gives us this push, how are we going to know that this is the point where we are going to be looking for sales from? That is where the session highs come from. Because as the market is opening, it opens with the Asian session. That's when we shall look for Asian high, so that we use the Asian high sweep as our entry point for more sales. So we put our indicator back. So when we put our indicator back, we can see this is our session high. This box you're seeing, let me mark it. So this box you're seeing, it is the Asian range. And you can see in the Asian range, of course, you cannot get any entry. So in this Asian range, that is the accumulation phase. So where is the manipulation phase? The manipulation phase, it is this candlestick that closes, sweeping this liquidity. So when you go on the 15-minute, of course, we shall, now this time around, the other time around we were in a bullish scenario. So in the bullish scenario, we are looking for the last sell candle. We mark its body. Now this time around, we are going to mark the last buy candle, which is this candlestick. We mark its body, lower body. That is our change in state delivery. Our change in state delivery. I've marked it on the 15-minute, but previously I've been marking it on the 1 hour time frame or even on the 4 hour time frame. So you keep zooming in the time frames according to what you're looking for. Now here after
Alban,
getting,
is your
yes,
colleague ready for the next hour?
our change in state delivery. I've marked it on the 15-minute, but O'Brien, are you ready for the next hour?
Yeah, I'm ready. Are you hearing me?
Yeah, I'm hearing you. Let me first finalize this setup of
All right.
GBP. So this is the change in state delivery on the 15-minute. But then when you come on the, we can see this is our Asian range. So when the price grabbed the Asian range, it didn't give us a sell off immediately. But when you look close, even there was a surprise zone. So our change in state delivery, this sell candlestick closed below. So our sell would be targeting the Asian row. So this would be our sell off immediately after the closure of this huge sell candlestick. Our sell would be here. We put the stop loss slightly above, risking around, let's give a risk like of around 15 pips. Then, and this would be our take profit on GBP USD. So I think, O'Brien, you'll talk about the Actually, the same thing happened here. Though price did not move according to the session, but at least according to the candle closure, then it was having also a supply. It also gave a huge sell-off. This one was actually a direct entry, which is not having a clear confirmation. But when you still zoom in, you can see there's this row. This last buy candlestick, the body, the row. So literally this entry, which is having a clean confirmation, when you have confirmed that sellers are in total control, that's where the entry would be. But the other entry was directed at the supply zone. It was directed at the supply zone. But the best and a clean entry would be when the price has showed us a clear confirmation, which is this one right here. I'm having 4 more minutes. So I think these 4 more minutes, let me check on what is happening with the news. Already news were released. Let's see what has happened on gold. So you can see the other trade of gold. The other second entry was stopped out because there were news which were coming. This entry on gold. But still, according to how today's candlestick will close, we shall be looking for maybe some other trades tomorrow to depend on the candlestick closure. How today will close, then tomorrow we shall react accordingly. But it's someone who was trading and doesn't trade news, fundamentals, and is not even having a clue about the fundamentals, would just exit the trade from this point before the news come in, then maybe we wait for some other entries the next day. Because the news were literally affecting US dollar. So that's why it is signaling that the dollar has gained some bit of momentum. That's why gold is selling. The same thing. So when you check on the DXY and USD GPY, DXY, of course, those ones are the best movers of US dollar. Yeah, I think I should stop here. For those who are listening, thank you for listening. Let me give an opportunity to another presenter to take over. Thank you so much.
Yeah, okay, thank you, Mr. Alban. So I think I want to share my screen right now. Entire screen, share. So you guys will tell me if when you start seeing my screen. Yeah, okay, thank you, Mr. Alban. So I think I want to share my screen right.
Yeah, you can see your screen.
All right. Right. So let me go to trading view. So my screen is visible, I think. Is my screen online?
Not yet. Not yet.
Okay. Let me share the screen.
It's loading. Yes, your screen is visible.
All right. So good evening, everyone that's watching. Yeah, my name is Salma. As my colleague, I think we didn't introduce ourselves, but the one that was presenting before is Alban, and I'm O'Brien. So we are like trading partners. So we developed this strategy together, and yeah, today we are presenting it to you. It's not that we developed this strategy, because this strategy is smart money concepts approach. Yeah, because before we were trading smart money, and yeah, we added in some ICT, we added in this and that. So that's what you're seeing today. So basically, as my colleague had already explained, I don't like he has explained almost everything, but I'll be going over the few bits. So basically, to trade with this strategy, what you start with is the daily, because we are day traders and we are targeting the daily moves. So like time to time, you'll find us like swinging on some trades, like holding for some longer time. But basically, the intention of our trades is always like to get 60 pips from the market, get 80 pips, and go out through the day. So one of the key elements of the strategy is to start on the daily time frame. You can start on the monthly. I've seen people start on the yearly time frame, but for us, basically, we start on the daily time frame. We get the daily bias. After getting the daily bias, we go down, we scale down, which is called, I think, um, like higher time frame to low time frame. So we start with the daily, then go to the 1 hour, then entries can be on the 15 minute, can be on the 5 minute, depending on where you get your good setup. So another thing, those of you that are not like conversant with the DXY and the Japanese basket, as you were seeing him present, these are the indices for these pairs. So for the dollar, we have the DXY, which is the index that measures the power of the dollar. So I always see people saying that you have to clutter down, like reduce the clutter on your charts, trade few pairs. And this is true, because like if your eyes are on many pairs, you definitely make a mistake somewhere. But like with this concept that we approach with in the markets, using the DXY and the Japanese basket, so we'll give you like the clear view of almost all the pairs that have these as their secondary or primary pairs. So let's say you're trading the Euro USD, you analyze the DXY. After analyzing the DXY, and you see that the DXY is in an uptrend, like here, where we are seeing that the DXY was in an uptrend, you will know that automatically the pairs that have the USD as the secondary pair, or that like your USD, GBP USD, AUD USD, are definitely selling, because when the dollar is gaining power, then that means the other pairs that have it as the secondary pair are losing power, because they are paired together, right? Yeah, so that's it. So the DXY, when you analyze the DXY, you have analyzed almost all pairs the with the US dollar. So you go there looking for entries, looking for good setups. Yeah, just like that. Yeah, so let's try to analyze the DXY for now. As we see, the DXY has been kind of in it's not an uptrend. If we scale down on the larger picture, we shall see that the DXY was in a downtrend, because you remember when Trump was elected in power, the dollar started losing momentum due to the tariffs and stuff. So the dollar on a bigger time frame, it was in a downtrend. But recently, due to the war in Iran and Israel, we have seen the dollar gaining momentum. And why? It's because the dollar is like the US is one of the biggest exporters of oil, and oil has been exploding recently. If you have been like on the fundamentals end of it, like listening to the news and stuff, you know that oil has gone to the roof. So if we go to US oil right now, you will see that US oil has been pumping. At one bit, it pumped to, sorry. So at one bit, we see that this oil pumped to around $118 per gallon. So with this, we expect the dollar to also buy for some time. Not that technically the dollar is supposed to be buying, but due to this war and stuff, where things happen. So let's analyze the DXY. So if I was to analyze the DXY, I would start with the bias, like where am I going to be taking my trades towards? So we see we have these areas. As my colleague explained, these are areas of liquidity. So every time you see a high, every time you see a low, those are areas of liquidity. And guys, just know liquidity drives the market, because for the big money to move, they have to like, if you want to buy a big share of the market, you have to have people that are going to give you the liquidity, to give you the money to push that price. So that's why after taking liquidity, in most cases, we see that the price runs. So for example, let's say here, we see here, this was a high. We overran that high. We came close below. My guy explained the strategy very well, because if we are targeting liquidity now here, what we shall do, we shall zoom in. After zooming in, this is the daily. We shall always see what is happening on those, how are they called, on the PDRs, like those points of interest that we have. When price reaches this high, we see how price started behaving. There was this, it pushed up, pushed back in. Let me zoom in so that you can see properly. So we see that there was this push up here on this candle. Then price pushed back. That was the close. So on the next day, we were hoping for price to come, retest the 50% of this candle, and then continue pushing up. But that's not what happened. We see price retraced into this candle, tried to push back up, and swept here. Don't know if you are seeing properly this one, but I want you to see it. Yeah. So our interest would be in this area. If we were trading at this time of the week and we saw this, our interest would be in this area here. So we are seeing these three candles. We are seeing there is a candle that pushed up, taking this liquidity. There is a candle that pushed back in immediately. So what is the behavior that we normally see when we take liquidity? Fast moves. Price, let me draw to show you what we were expecting. We were expecting, let's say, people that trade break and retest, they were expecting this move to come, break out like this, retrace, and then continue going up like that. So that's what was expected of this move. But then we see that on this high, after taking that liquidity, we see there was this impulse. We pushed up, then there was no time, we pushed back in. So there is this kind of V. So with that kind of V, that push up and back in, that's what gives us the liquidity grab, like a liquidity grab. So we shall go now on the lower time frames, let's say the 1 hour, and look for the change in state of delivery. And I know my guy explained the change in state of delivery very well, but what it basically means, it shows an order broke, because the fundamentals of the strategy, that we have market structure, which is the price is moving in this form, forming higher highs, higher lows, higher highs, higher lows. Yeah. Then we have a market that is also moving in such a way. Yeah. So we have this type of market, this one, which is the uptrend, and then we have this one, which is the downtrend. These are basics. I know you all know them. Then we have basically this one that moves like this. The one that he was calling the consolidation that generates liquidity. In most cases, this is where like most of the liquidity is being generated. So if we are to look at this area here where he was analyzing the DXY, we shall see that the market is at this point here. The market is definitely in this kind of trend. So we have been generating liquidity. And if you are aware of the power of 3, where we have the accumulation, the consolidation, then we manipulate. Let me show you what the power of 3 is. So in the power of 3, we have the price is accumulating. Price accumulates like this. Then we get a manipulation. With that manipulation, we come back in. We see now the V is forming. On the manipulations, we form that V. Then after forming that V, we now have the distribution where price now starts distributing into a move. This could be in a downtrend or an uptrend. So basically, the power of 3 shows you that when we have this consolidation, right here, we now don't trade in this, because if you're trading in this kind of market, you're crazy, because you'll be stocked out like 100 times. So when we see this happening, we wait and look for a manipulation. So let's say this was our manipulation here, because we see now we took those highs at that level. Let me, yeah. So let's say that was our manipulation. We now came back in, and now we are looking to trade. So how are we going to trade now? That's where the concept of the change in state of delivery comes in. We are forming an order block. So as we were pushing up here to take this liquidity, we are definitely forming candlesticks. We are forming candlesticks like this. Let's say that's our candlestick. Let me make it red. Fill it with red. So as we were pushing up, we have that candle that formed pushing up. Then we have another one that forms here. Remember how the candle forms? It opens from here, pushes up like this. Then let's say if this was a liquidity grab, it will come back and close, let's say like this. When it closes like that, we shall have a wick. We shall now have a wick here. Let me add my wick. We now have a wick. Sorry. my skill of drawing has refused, but I think you get what I was trying to mean. It will form a wick, so we shall be having a wick that grab this liquidity, like this one here, like this one you see here, that grab. This is a wick, and this is also a wick. So if we are to use this scenario, the change of state in state of delivery will be drawn on the last opposite candle that took the liquidity. So let's say this was a buy, this was a buy candle that was taking the liquidity. So we mark the body of that candle like this. So that's the body. And when you get a close, like when you get a close above of a candle, now this was a buy. Now we have a candle that has closed back above that body, like this. Fill it with green. Yeah. So this was the last one that happened that formed when we are taking this liquidity. Now we came back inside, and now this is the one that has closed after we have taken our liquidity. It has closed above the body of the other one that was taking liquidity. Now that is our change in state of delivery. And why do we mark the change in state of delivery? Because that change in state of delivery will now, let's say it formed here, will now help us to identify the order block. On the order block, that's where we shall take the trade. So let's say this was a scenario. What we shall do, we had accumulation, we see that we had a manipulation, then we had our change in state of delivery, and now we have crossed below the change in state of delivery. What we shall do is just look for trades, a short position on the order block here. We shall look for a position. We put the stop loss above, slightly above, as my colleague said, and we shall target a 1 to 2. Let's say we have risked $1 to make $2. We shall target a 1 to 2 risk to reward ratio. Yeah, that's all. We shall not be greedy. We shall not do what. We shall just target a 1 to 2, and we take our trade. So that's basically the whole thing, how it works. So now let's use an example. Let me first show you some of the trades, some of the examples of trades that we have taken in the real market. So this was an example of the trade. By the way, this one was today. Then we have this one. This one was from GBP GPY. You see how these trades always have like almost zero drawdown. If you have a good setup, then you get a good entry. Then this was on the weekend on Bitcoin. Then yeah, this is the same on Bitcoin, the one I showed you before. Then we have this one. This one was on the US dollar Japanese yen. Also almost zero drawdown. It's this one in MetaTrader. Yeah. So you see this one. This one was on, I think this is Euro USD. You see they are very good trades with good risk to reward ratio. This one was on GBP. This is GBP USD. Yeah, this is British pound, US Japanese yen. This is the trade. So I think you see that the thing works. Like if you refine your entries, get good entries, you get good trades. Yeah. So basically that's it. Let me try to analyze one or two pairs. So if we are to analyze the dollar, we have seen the dollar was previously in a downtrend. Now we have reversed back to an uptrend. So if I was to look for trades on that, like on dollar pairs, what I would have looked for, first I would have marked this fair value gap. This is a fair value gap. Fair value gap. Let me reduce the pixels. Yeah. So this is a fair value gap. And how does a fair value gap form? So we all see that we have let's say a candle that is like this, we are trending up, and it has a wick. My wicks are refusing to, yeah. This is my candle, it has a wick. We know that candles normally have even 2 wicks like this, yeah. So the next candle that opens, let's say it will, this cross this, let's say we're in a bullish scenario, so the next candle will open from here like this. It will, let's say, first go down like this, go do this. If it reaches this price, then it will leave down a wick. Let's say now it comes and crosses above like this, so it will leave a wick down here. It will have to leave a wick down here. Then let's say it also reached some price here above, it will also leave a wick here, yeah. So this is basically how a candle forms. I know these are basics, most of you know these things. So let's say this candle, we see the wick is here, the candle crossed here, it has another wick above, and the candle crossed here. Let's say now the next candle that opens, here just goes down a bit, then now goes up and crosses here. So if it goes down a bit, we see that it went down like for just 10 pips or 5, and from that wick. Now it has crossed above, and we are looking for a fair value gap. How do we find the fair value gap? What you shall do, you will mark like we have to be having 3 candles in the picture. You will mark the previous, the one for the previous day, the high. Obviously the high is this week. We shall mark it like this and look for the row of the current candlestick. So the row of the current candlestick is this one here. So if we mark those two prices, we see that there is this thing that remains in the middle that is untouched. It wasn't filled, there wasn't price at all. On some brokers, like on some charts, you will see a gap, like a real gap, like here. This is a real example. This, because it was in the weekend, this formed here. But if we are in the normal trading days, you won't see a gap like this. You will just see candles forming. But if you mark the previous candle high and the current candle, you have something like this. So this is what they call the fair value gap. Yeah, for those of you that had no idea of what we are talking about, this is the fair value gap. So the fair value gap will act as a point of interest where price might reach and reverse, like, because let's say we are in a buy situation, we are here buying. So every price you see, there was a seller at that price, but you see inside this gap there were only buyers. There were no people that were selling in that price. So in between there is a gap. So price, in most cases, when price comes back to this area, it reacts to those areas and either pushes up or either pushes down. This happens in both scenarios, when price is buying or when price is selling. So I would have marked this fair value gap. Now I think we all have an idea of what fair value gap is. So with that, I would mark this fair value gap right here as a point of interest where I'm expecting price to come. Then we see another kind of formed, the next day formed, the next day formed. So when price took this high, we see this is a high here. When price takes that high, that was liquidity. Let me mark it as liquidity. Yeah, when price takes that liquidity at that high, we now start expecting price to reverse. So we start expecting to see sales, like in the market, people selling back to even targeting this. We now see we have another liquidity here down below. There is liquidity on, remember we said there is liquidity on the highs and the lows. On then internal range liquidity are these internal highs, internal lows. We have fair value gaps can also act as liquidity. We have inversion fair value gaps. So all that. So when we took this liquidity, we're expecting that price will maybe come back and start selling. If it disrespect this fair value gap, now would be like price is changing, like the delivery is turning now to sell side. So we see what happened. We started ranging, and with ranging, remember we said in this type of market, it's better if when you're not trading. It's wise when you're not trading in these days. So that was a ranging market. And what did we see? We see that now, when was it? This was 10th, on 10th. This is the kind of 10th. I think it was Monday. No, Tuesday. So we see that we had now our move. Let me go now to the 1 hour so that you can see it properly. So with our box, the range, you see how price was not going nowhere in that box. Now we see that price did what? What price did was do our V. We said when we are grabbing liquidity, what we want to see is a V. So what we want to see is a quick drop and a quick recovery. So that's when we can consider it as a what? A liquidity grab, because we see there was liquidity on all these rows here, and we now grab liquidity. But let's say price was now doing this. Let's say instead of coming in one, we saw price doing this, doing this, doing this, doing this, doing this. This is not a V. If price was doing like this at this area, our point of interest, we wouldn't be interested in this, because this is not a V. This is very slow. So we don't want to take liquidity in such a slow way. So we see that the liquidity grab here was very sharp. So we took this liquidity. After we have seen that there was a liquidity grab, what we shall do is now mark the sell off, where the sell off started. Where do we start to sell off? We started to sell off right here. We shall put there our line like this. So that's where we started to sell off. We shall wait now. When price comes, we need to see a candlestick cross above. We need to see a candlestick that has crossed above our area. So this is what we had called the change in state of delivery. The change in state of delivery. So with that change in state of delivery, so we see that our liquidity was taken. Let me go back and mark it so that you can see it properly. On our box, let's mark liquidity on our box here. So this is the edge of the box. We shall put there liquidity. This is liquidity. Yeah. So when we go to the 1 hour, back to the 1 hour, we shall see the line below. Let me change it to red so that you can differentiate it. So the red line, that red line is where we took liquidity. So after taking that liquidity, we shall mark this the change in state of delivery. If price comes and doesn't cross above this changing set of derivative, we are not interested, because our setup will be right only when we have a closure above the changing set of derivative. So when we get that, now we shall see that there was a closure. When we see this candle, this one here, closed above. So when it crossed above, what we shall do, we shall now look for a fair value gap. Like what can we take our trade off of? So we shall now mark a point of interest where we see there is this wick of the candle, then there is this previous one, and in between there is nothing. So there is nothing. So we can mark it like that as our fair value gap. So if you see properly, you see on that candle there is nothing, no price that filled, because we have no wick here. If at least this wick was like this, if this wick of this candle was like this, touching this one like that, we would have no fair value gap. But we see the wick of that one starts up there, so we have all this space, so we mark that as our fair value gap. And what we shall do, if you use Fibonacci, if you use the premium and discount tool, you can set your, let's say this is I use the premium and discount tool. I will look for a row. This is the row, and this is the high. So this is it. So I will be putting my position on at least on the 50%, because we see in the green area that's premium, and in the red area that's discount. So we always want to buy at a discount. It's not good to buy in premium because you're paying too much. So it's better when you buy at a discount. So if I'm using this, then I would use, let's say, a limit order, and I put my trade on the, oh, sorry, we are buying. So we are wronging. So we look for the 50%. We put a limit, put a stop loss. Let's say we risk 1% to target 2. We target 2, 1:2. That is a trade. So basically, this is a trade that I would have taken if I had been in the market at that time. That's a trade I would have taken, because that is a good trade. That's a very good trade. You see, the risk is very low. You get almost 0 drawdown, and yeah, that's how it is. Then let's see the next day. So now we see the next day we have a gap here. This is news, probably due to the oil scandals and stuff that's happening in the Strait of Hormuz. Yeah, but we see we have a gap. So if you are someone that likes holding trades, you would look for liquidity above. Now you see we took liquidity below this box, and the next liquidity that we have would be liquidity above this box, because it was a range. So we take liquidity on one side to target liquidity on the other side. So if you're greedy like me, in most cases, you will hold this trade to target that liquidity up there. So that's how it would be. Yeah. If you target that liquidity above, then you would have a 1:4, like a 1:4 risk to reward ratio. And remember, when you get this trade, then on the other pairs, on all the other pairs that have the dollar as the secondary pair, if we are buying the DXY, then we are selling Euro USD. So if we go to Euro, USD. That means we have the same setup but in reverse. So this would be the same setup but in reverse. So this would be a sell. We would have been looking for a sell. So if you don't analyze the DXY and you analyze only the EURUSD, that means you'd come look at the chart. You have something like this. You have something like this. Then we mark the areas where price might be able to react from. We mark our fair value gaps. We see we have this huge gap here. We have that huge gap. Then we also have this gap, this not so huge but significant. That's it. Then now after marking those fair value gaps, those are our points of interest. Now we shall be waiting for a reaction in one of them, because it's not a must that price can react in this first one. Price might first come to retest this one. So we just wait for a reaction. So we see there was a reaction here on this day. So on that day, what we shall do, we now just go to the 1 hour. I think you're seeing how I'm using very minimum time frames, not the monthly, weekly, then I go to the 2 seconds. No. So after that reaction, what we shall be looking for is a what? A change in state of delivery. We shall now look for the last candle that formed with an opposite color before we tapped into our liquidity. So we see that we tapped into our liquidity here, and it's a nice V. When we do this, we see that price was forming an uptrend like this. We formed an uptrend. We are continuing up, but we tapped into the fair value gap and we reversed like this with a V. So this is a sharp turn, so that counts as a liquidity grab. So we shall mark this as liquidity grab because there is no candle that has closed above that price, and still it has now changed direction. So when we do that, we have marked that as our liquidity on that pair. Now we shall come to look for the what? For the last candle, the last opposite color candle that had to put in our high. So on a normal day, I would have marked this one like this. I normally use blue lines. So on a normal day, I would have marked this one. But if you're keen enough, you will see that the last sell candle that led to our liquidity grab was this one, was this indecision candle here. So though the body is very small, some people would mark that one like this. But you see, if you had marked that one as your change in state of delivery, then and you waited to enter on it, then you would miss out. So I advise to look for significant candles that look like real candles. So we have this one here. So I would have marked that one, and then I look for other confirmations. So to look for another confirmation, then I would see that we have a fair value gap, an imbalance, fair value gap, imbalance all mean the same. So I would see that we have this fair value gap right there. Yeah. So you can enter a trade either using a limit, or if you're in the market at that time, you can enter on the 50%. Then if you are over conservative and you don't want your stop loss to be hit, then you risk like here on the top of the wick, because you know that's a protected row, and then you target 1:2. 1:2 right there. Yeah, 1:2. If you want to get in and out of the trade, but if you have the ability to hold, then you can hold up to this sell side liquidity here, because we said highs and lows are liquidity. Yeah, so you can take partials at that 1:2, then hold some other the remaining trades until you hit TP2. Yeah, so that's basically about it. So we have liquidity and order blocks. So these areas you're seeing me marking the change in set of the derivative. If we go to the daily time frame, let's say we go to the daily time frame. You see now, if you're on the daily time frame, you won't see that there is an order block in that area. You will see just a wick and price starts reversing. But if you are on, wait, let me go to the 4-hour. So if we go to the 4-hour, you will see that the area I marked as my change in state of derivative, this area here. Let me remove all this. Remove all this so that you can see it properly. So if you see properly, that's an order block. Those people that trade smart money concepts can testify. That's there. Let me remove also this. This here is an order block. Because an order block, properties of an order block, it should grab liquidity, of which it did, and it should have an imbalance, which it had 3 candles and an imbalance. Yeah, so that's how you find order blocks using the change in set of delivery. So the fair value gap is explained the liquidity, those highs and lows, those equal lows. When you see them being swept, just know the liquidity is being taken. Yeah, it's not that there is money there that is being targeted or something, as most traders say, but just know that those are areas where like many orders are placed, and on highs and lows you target those for liquidity. Yeah, so market structure, as we had explained, those are the higher highs, higher lows, that like knowing the phase of price, like what price is doing at a specific time. So that's the concept of the market structure. Yeah, so I think I've explained almost everything, and my colleague had explained most of the bits. If you are just coming to view, you can, I think this live stream is recorded. You can go back and watch the first presenter. He explained a lot. There is a lot of knowledge in the presentation. Yeah. So risk management, we have talked about risk management. Like if don't be greedy to enter and target like, so we're already getting good pips, because if this was a trade that you took, let me see, let me use the price range from this entry to here to TP, you see it's almost already 100 pips. So you're already getting like good risk to reward. So don't be greedy, target 1:2, 1:3, realistic like gains. So yeah, I think that I have explained it all, and let me see if there is anything else.
Also, what can you do gold analysis?
Okay, boss.
Can you do
Yeah,
gold versus USD?
so let's analyze XAUUSD, which is gold. Yeah, so right now we see how gold is behaving when we come to the daily time frame. So when we come to the daily time frame, we see on the larger picture, gold is in an uptrend. Gold is in an uptrend. So if I'm to mark the liquidity we are targeting, we have buy side liquidity here. We have buy side liquidity, and we have this sell side liquidity. So both, this is buy side and the one down is sell side. So both these areas have like potential of pulling the market. So we see these formed in just 3 candles, and all these candles are just inside this range. So I wouldn't say that it's bad to be trading gold at this time, but it's just risky. But what we shall do is analyze what's happening at the moment. So at the moment, we shall see that we have, if we had marked using our fair value gaps, we see we have this imbalance that was here, this imbalance here that was filled. It has been retested many times, it was filled, and now we have potential of targeting this buy side liquidity from this fair value gap here. So knowing that, we shall have to see which other areas might like affect price, like where price can react from. So if we are to see properly, we have another fair value gap right there. So with that being seen, we see we have these 2 areas. So some people who trade support and resistance know that now this one down is the support, the one above is the resistance. So price is just there in the middle. If we analyze further, let's see. Today, so there was a liquidity grab right there, here. As we tapped into that fair value gap, there was a liquidity grab. I don't know if it's visible. Let me make it red. Yeah. Let me remove this one because you already see the fair value gap there. So we see that there was liquidity grab right there. So yesterday, if you saw that there was a liquidity grab and you go to the 1 hour, let's go to the 1 hour and see what's happening. We see here, yeah. So yesterday we are seeing that we took liquidity right there, and in a V, because we said we want to see price take liquidity like that and sharply come back inside. So if we are to see this, we see that there was liquidity grabbed right there. And what is the last area that took liquidity? If we are to see on this move that took liquidity and we came back inside, we can mark this body here of this candle like that. Yeah. So remember, this is on the 1 hour. That means all these you're seeing are hours that we are waiting. Because right now, if you mark this one here, this is this is not the change in set of delivery. And why? Let's see. This is a buy, and yeah, like this. If you mark that one, if you mark this one as your change in set of delivery, you're lying, because where did we take liquidity? Where did this high take liquidity from? I see we have this fair value gap right there. We have that fair value gap right there, but we never had this high take any liquidity. At least if it had taken that liquidity like this, if it had taken this liquidity like this and then it comes back, then we would have considered it as the change. But now the one that we're considering is this one right here, because it's the last buy move that took liquidity and then we started closing in. Yeah. So if we mark that one, you will be waiting for this candle here. You see, there is, let me remove this one. You see, gold price action is very messy these days just because of the news and stuff, but I think we can go through it. So I think you see this candle right here, that candle that I'm pointing on. You see where it crossed? It crossed above our blue line there, our blue line. So that's what we would have been like targeting for, waiting for. And when we see it crossing there, we shall mark its wick as the protected high. This is the protected high right there. That's the protected high. Change it to black. So with that as the protected high, I would have entered. Personally, I normally enter immediately after the closure of the candle, but it's okay to wait to go on the right time frame. Let's say you go to the 15 minutes here, and you look for an entry. So as you see, if you, this is the protected high, the one we marked here, and we see what would we have considered as the entry criteria. We would have waited for this fair value gap on the 15-minute here to be filled. So as you see, if it was tapped into here, so most people would have sold here, including me. So I would have sold on this fair value gap right there at that price, and I put my stop loss above the protected low. So targeting 1:2. 1:2, like this. Yeah. So if we are to check on this trade, you will see that price almost stopped us out by just like a few points. It almost stopped us out, but because that's a protected high, we see that price had to reverse and do the needful. So when we analyze today's price action, let me see today, one day. So we see that gold is still selling. It's selling. So only that traders, we normally buy off our plans, but if you analyzed well, then you would be targeting this liquidity down here, this candle. You see that candle that took liquidity, so we have liquidity right down here. So that would be our target, our first target. Then we shall see now how, because we are in between 2 points of interest. We are between 2 points of interest. This one here, it even has an inversion fair value gap. So what is an inversion fair value gap? So you see this candle here, this one here. Let me remove this. Mark it for you. You see this candle that I'm marking right there. So you see that candle, it has a fair value gap right here, like that. But that's a fair value gap that we would have expected for price to push up. So we would be expecting for price to come like this. We would have expected for price to come, tap into our fair value gap, and then continue going up. But what happened due to Trump? We blame Trump. So you see, the candle wiped it out, and it disrespected this fair value gap of ours. So with that, that becomes an inversion fair value gap, IFVG. So it has been disrespected. Now you see in future, now it has acted as like a point of interest for sellers. Yeah, so that's an inversion fair value gap. So if you combine it with this FVG that we have, because you see they are two in one. We have IFVG on the other side, and we have fair value gap on this side. So we see we are in between this one and this one. So if we take this low, this liquidity, then now we shall see how the candle will close. Let's say our candle comes like this. Let's say our candle comes and crosses like this and now goes back up, like crosses inside. So now we have a week. Now we have another week here. So let me extend it this side. So if our candle crosses like that, so now you see that we have another week tapping into this same point of interest. So now we shall start seeing this as a grab of liquidity for this day. And now we shall start looking at how we can take price back up to target liquidity. So basically on gold right now, the advice I can give is to be targeting like short-term liquidity, not long-term liquidity, because where we are in the middle of 2 points of interest and anything can happen, because this is a strong point of interest and it can easily push price and pushes price back up. And this one also, you see there was a lot of activity in this area, IFVG, this one. So it can also even push price very low, like back down to here. So it's kind of a consolidation situation, but you can still get good trades if you are good at analyzing. Yeah, so that's basically gold for you. If you go to 15-minute, yeah, we see we are just a few pips away from the target. This one here. Yeah, so if you get used to the strategy, you can easily see trades in here when you just look at the charts, because right now, if I'm to see on this 15-minute, I can see that we have just here on this area, I can see that we have this liquidity grab. Yeah. So that's a liquidity grab because we see our V shape, our V, we are taking liquidity of this week and we come back inside immediately. And when we mark our last buying power, it's right there. The last buying power was there. And we see we just wait for a candle to cross above it. We see this one try to cross above it, but it didn't. price just played around, and now this candle here, this one here, is the one that broke through. If you're looking at it very well, this one is the one that broke above this one here. So what you can do is look for a point of interest. But me, I always enter on that candle. I risk. Then we have that fair value gap which has been tested. That one there. You can wait, but me basically I enter right here, a short position, then put my stop loss at the protected high, then target 1 is to 2. 1 is to 2, just like that. So if you check properly, we already have like 2 trades clean right here, just from observing. Yeah. So that's gold. For now, I can't get a setup right now because as you see, the price is already gone. We can't force trades. But basically that's it. Yeah. So that's it. Thank you for listening, those that are tuning in. I don't know how many are they, but yeah, I think that's it from me. Maybe if anyone else wants to add on.
Right. Thank you.
Yeah.
Thank you, everything.
Thank you for listening, those that are tuning in. Don't know how many are there, but yeah, I think that's it from me. Maybe if anyone else wants to add on.
All right. Thank you. All right, we will be able to end it here today. And yes, come up with another program tomorrow. But thank you for joining. See you on the next one.